Wall Street analysts spend billions of dollars studying quarterly earnings reports, while completely missing the single invisible engine that generates 90% of this market leader's actual cash. When you look at the surface of a dominant corporation, you see spreadsheets, marketing campaigns, and glowing headlines. But Charlie Munger spent his entire life looking past those illusions to find the cold, hard machinery humming underneath. He didn't care about what a company promised to do next quarter. He cared about what it was physically impossible for competitors to stop it from doing over the next 20 years. And right now, we are going to dissect a massive market leader using Munger's most ruthless Economic-Moat test to expose the hidden financial reality that most investors never see until it is too late. Think about how Wall Street evaluates a successful business. They look at revenue growth, profit margins, and earnings per share, treating a company like a racehorse, judging it entirely by how fast it crosses the finish line today. Munger always laughed at that narrow view. He knew that a fast-running horse means nothing if the track itself is built on quicksand. Instead, he treated a business like a medieval fortress. He wanted to know how thick the stone walls were, how deep the water was in the moat, and whether the crocodiles inside were actually hungry. When you apply this forensic mindset to a true market leader, the very first thing you discover is that financial statements can lie, but customer behavior never does. Let us look at a classic case study of how this works in the real world. Imagine a company that dominates its industry so thoroughly that every single competitor feels like they are throwing pebbles at a titanium wall. On paper, their profit margins might look normal, their growth might even look modest. An amateur investor looks at those numbers and says, "This company is too slow, I want something exciting." That is the exact moment the amateur walks straight into a trap, because while they are chasing excitement, the market leader is quietly harvesting billions in high-margin cash flow without spending a single extra dollar to protect its territory. How is that even possible? The answer lies in a hidden mechanism that Wall Street accountants completely fail to measure on a balance sheet. Let us peel back the layers of this financial engine. To understand where the real money moves, Munger always used a mental model called inversion, solving problems backward. Instead of asking how a company makes money, he would ask, what would it actually take for a well-funded competitor to steal this company's core customers tomorrow morning? Let us run that experiment together. Suppose a rival corporation raises $10 billion in fresh capital. They hire the smartest engineers on earth. They build a product that is 20% cheaper and slightly faster than the market leader's product. Logic tells us that customers should switch immediately, right? Rational economics says the cheaper, faster product wins the market share. And yet, in the real world, something bizarre happens. The customers do not move. They stay right where they are. They ignore the cheaper price, they ignore the faster technology, and they keep paying the market leader year after year. Why? What kind of hypnotic spell does this company have over its audience? The answer has nothing to do with product quality and everything to do with operational integration and sheer psychological terror. Let us look deeper into that terror, because this is where the real economic moat is forged. When a business buyer or a daily consumer integrates a product into their core workflow, that product stops being a vendor and starts becoming oxygen. If a business relies on a specific software or industrial component to run its daily operations, switching to a cheaper alternative is not a financial decision. It is a massive operational gamble. If the new, cheaper tool fails for even 1 hour, the company loses millions of dollars, damages its reputation with its own clients, and triggers a corporate crisis. Therefore, the cost of switching is not just the price of the new product, it is the catastrophic risk of total operational failure. Munger understood this better than anyone on Wall Street. He knew that high switching costs create an invisible tax on the entire industry. The market leader doesn't need to harass its customers with aggressive sales pitches. They simply sit back, collect their toll, and let the sheer fear of disruption keep their customer base locked in an unbreakable cage. And this leads us to the most dangerous misconception about pricing power that destroys ordinary investors' portfolios every single day. Most people believe that pricing power means raising your prices when your costs go up due to inflation. That is not pricing power at all, that is just corporate survival. True pricing power is the ability to raise prices aggressively while your actual cost of production goes down. Simply because the value of your network has compounded to a point where customers have zero alternatives left on Earth. Imagine a company that increases its prices by 10% every single year, while its manufacturing or operational costs remain completely flat or even decrease through scale. That spread, that growing chasm between falling costs and rising prices, is where generational wealth is created. Competitors watch in absolute despair as their own profit margins shrink to zero in a brutal price war, while the market leader expands its margins, prints excess cash, and uses that war chest to buy up adjacent assets. It is financial gravity at work. One side is fighting for its life on a treadmill that speeds up every year, while the other side is standing on a compounding machine that runs completely on autopilot. Now let us push past the obvious metrics and uncover the third hidden layer, the mechanics of multi-layered distribution networks. An exceptional business model does not just sell to an end user. It embeds itself into the entire distribution plumbing of an industry. Think about a company that controls the primary gateway through which suppliers, distributors, and buyers must communicate. If you are a supplier, you cannot afford to ignore this market leader because that is where 90% of the buyers congregate. If you are a buyer, you cannot leave because that is where every single supplier lists their inventory. This is what Munger recognized as a two-sided network effect on steroids. It creates a self-reinforcing loop where every new participant makes the ecosystem exponentially more valuable to everyone already inside. Competitors can try to build an alternative network, but they hit a brick wall known as critical mass liquidity. Without buyers, suppliers won't join. Without suppliers, buyers won't look. The market leader sits right at the intersection of this economic traffic jam, collecting a toll on every single interaction without having to lift a finger in heavy manual labor. It is an asset-light toll road operating at global scale. This brings us to the fourth hidden layer that separates enduring market leaders from flashing corporate shooting stars: capital allocation discipline. Munger always emphasized that a brilliant business model can be utterly ruined by a management team suffering from the deadly sin of hyperactive capital allocation. Mediocre leaders get a massive stream of cash, and what do? They panic. They feel an urgent need to look busy, so they buy unrelated companies at inflated prices, chase trendy fads, or launch expensive vanity projects to impress financial journalists. They treat free cash flow like burning money in a fireplace. A truly elite market leader behaves with cold, calculated emotional detachment. When they accumulate massive piles of cash, they wait patiently like a predator in tall grass. They do not waste capital on stupid acquisitions. Instead, they reinvest only into projects with guaranteed high returns on capital, buy back their own shares when the market undervalues them, or hoard cash until a severe industry crash hits. When the crash arrives and competitors are gasping for air with empty bank accounts, the market leader steps in with its fortress-like balance sheet and buys up crippled rivals for pennies on the dollar. That is how a dominant leader uses a downturn not to shrink, but to widen its moat so drastically that no one can ever cross it again. Let us examine the fifth hidden layer: the invisible corporate culture of institutional paranoia. Munger often noted that success carries the seeds of its own destruction because comfort breeds negligence. When a company dominates its space for decades, its employees stop thinking like insurgents and start acting like lazy bureaucrats. They form internal committees, protect their turf, and focus on office politics rather than customer obsession. They stop looking over their shoulders because they assume nobody could possibly touch them. The rare market leaders, the ones that compound wealth across generations, actively fight this human decay. They institutionalize a culture of constructive dissatisfaction. They treat their own flagship product as if a group of smart college dropouts in a garage is about to render it obsolete by Friday night. This psychological posture changes everything. It means the company is constantly cannibalizing its own old products before a competitor gets the chance to do it for them. They do not wait for the market to force their hand. They disrupt themselves voluntarily. That kind of self-awareness is so rare in corporate history that when you find it, you are looking at a true compounding machine. And finally, let us look at the sixth layer, the ultimate test of customer emotional resonance. At the end of the day, numbers, balance sheets, and moats are just intellectual abstractions. The ultimate foundation of a market leader is how the customer feels in the quiet moments of frustration. When a user interacts with this company's ecosystem, do they feel trapped and abused, or do they feel quietly relieved that someone finally solved their problem reliably? If a company relies entirely on high switching costs and legal traps to keep customers hostage, the moment a truly ethical, superior alternative appears, the dam breaks and the empire collapses overnight. True market leaders do not just rely on barriers, they earn a subtle, unshakable form of customer trust. They become so deeply woven into the fabric of daily life that customers view them not as a vendor, but as an indispensable partner in their personal or professional survival. When you combine high switching costs, network effects, disciplined capital allocation, paranoid leadership, and quiet customer trust, you get a business that transcends ordinary market cycles. And yet, even when a company achieves this level of absolute dominance, there is a hidden rot that can destroy it from the inside out. A rot that Munger warned about until his final days. That rot is called intellectual complacency. When a management team sits inside a fortress with deep moats and billions in cash, they naturally begin to believe their own marketing. They start thinking that their success is a permanent birthright rather than a temporary loan that must be earned back every single morning. They start cutting corners on product quality to boost short-term earnings for Wall Street analysts. They stop listening to the quiet frustrations of their customer base. They assume that because the moat is wide today, nobody can ever bridge it tomorrow. Munger knew that every great empire falls because of internal hubris long before an external enemy ever breaches the gates. The most enduring market leaders in history are the ones whose leaders remain pathologically paranoid, operating every single day as if a brilliant competitor is about to put them out of business by sunset. They treat their economic moat not as a concrete monument, but as a living garden that requires endless, exhausting maintenance. As you look at the business world around you now, ask yourself a simple question. Are the companies you study relying on loud hype, flashy disruptions, and temporary excitement? Or are they quietly building the kind of inescapable operational necessity that Charlie Munger spent his entire life hunting for? The answer will reveal everything about who survives the next economic storm.